Good morning, Dale.
Well, good shaky morning to you,
Hey, we did something wrong. It's not Tuesday.
right? Well, yesterday was crazy for both of us. We just didn't get a chance to do it. And now the earthquake is causing even some more challenges. But it is what it is.
It is what it is, and we'll get it out. And you know what? Today's worth it a little bit because we got some interesting data that I want to show you, and we didn't have this data yesterday. But
Yes,
first, let's take a look at the elephant in the room, Dale. What do we got going on with rates?
I don't know. They're going up over the last 5 weeks, nothing but up. We'll explain it a little bit further in the video as to some of the reasons, but the reality is rates are not backing off anytime soon.
And we do know that because of these rates, mortgage applications are down at a 30-year low. So
Yeah,
it's maintaining there, and it's really tough. And a lot of people are wondering, what are the factors that are really contributing to this, and what are we going to look for? Obviously, inflation is the single biggest factor for mortgage rates or interest
yeah.
rates in general. We also see housing prices are still going up. We've talked about this a lot, so we won't get too in depth. But we also have the federal funds rate. And this is the data, Dale, that I wanted to kind of share with everyone. Um, it's really, really interesting. And I'm hoping you can give us some enlightenment. Let's take a look here at the Fed funds rate really quick. Back before the recession, the 2008 housing bubble, whatever that was, 5.125. Today, it's slightly higher, 5.375. And then take a look at the 30-year mortgage rate, 6.7 back then, and a full percent, 7.7 today. And then here's the difference. The 30-year versus the Fed funds rate, 1.58% cushion back then, 2.33 now. Well, what's the deal?
Well, all of this information is all interrelated. Everything affects everything. This is what we call hedging at best, right? You've heard the term hedge. You hedge your bets, right? Well, that's exactly what's going on, which is nobody's really sure what's going to happen, where the economy's going to go. So even though the Fed funds rate are very similar, mortgage rates are higher simply to try to hedge in case something even worse happens. Think of it this way. A bank 4 years ago, 3 years ago, loaned all of their money out at 2.5%. They're now broke because they're only making 2.5%. Everybody else is making 7, and they are just not keeping up, and they're going to go belly under. Everybody's hedging, all lenders, all mortgage companies, banks, credit unions, everybody's kind of hedging because we don't really know where things are going to end up in this puzzle. That's at least my take on it.
Oh, well, it makes sense. And basically what you're saying is like 4 years ago, someone got an interest rate at 2-3%. And now the bank has to pay 5.375 in order to borrow money. So they're only getting about half of their interest rate investment back on those loans 4 years ago. So what
Yeah,
they're doing nowadays is they're adding a 2.33% cushion in order to absorb the potential for the future. So they're thinking, well, if the Fed funds rate for some reason ever hits 7% or higher, we have a 2.33% cushion in there to allow us to absorb that cost should it ever get that high. Is that about it?
that, that's exactly what's going on. You said it much more eloquently than I ever could.
Well, no, I didn't fully understand it until you explained it. So I just want to make sure I personally have this because it is confusing, and unfortunately, it is a little bit annoying that they're hedging their bets so much because back then in 2007 they had about 1.5% cushion. Now they're looking at 2.33.
Yeah. In fairness, lending was completely different in 2007. It was more of a free for all. If you were breathing, you could get a loan, and it's just not that way.
Yeah. So, well, here's a hope that that cushion can start to shrink a little bit, and that will give us a little bit of relief on interest rates. And we'll see. I know that there's a lot of job numbers that come out. A lot of people think they might not be truthful, but we'll see what happens as the month continues. So.
Yep. That's all we can do.
We do have a credit education seminar coming up Tuesday, November 7th. That's the first Tuesday of the month, 5 o'clock p.m., either in person or online. If you need that link, give us an email, call, ring. We will get it to you.
And then, of course, the first-time homebuyer seminar, which is the third Tuesday of the month, November 21st. Again, 5 o'clock at the office, online, internet, smoke signals, semaphore flags. However, we will get the information to you.
Well, that's about it. Dale, I hope you have a great rest of your day.
Thank you. You too.
All right. Take care. Bye.
Bye.